Let's just get your view right now, I suppose, on the equity versus bond market or fixed income market going into 2013. What are your predictions right now?
As you mentioned, we've seen the bull run from the beginning of the year. This has been happening actually for the last 3 years. Every January we've seen quite a strong bull run. But this year, I think what stands out is that we're coming from a very weak, from a very low position actually in early 2012, and so this is quite exciting to the market. I think we are up so far about 10% market capitalization year to date, and about 8% on the index. This is quite exciting. It's quite a strong run. We expect it to continue holding. Most of it is being driven by foreign investors on specific counters such as the ABL, BAT, and KCB. And they're in the market despite the rising political temperatures and you'd say political risk. They're still in the market, still buying quite strongly, which is an indicator of their confidence in the market and of the elections and the post-election period.
And of course,
so and also if you work with the numbers, back with the numbers from where we were probably around 2006, 2007, we have quite a way to go.
Yeah, just looking at the bond market right now, we know that coming up are maturities of certain bonds. Has that spurred some position taking ahead of those?
Yes, actually, we have, as you know, the first half of 2013 has very heavy maturities, about 327 billion. About half of this are in the first quarter, about 170 billion. These are really heavy maturities. We've never had such heavy maturities. And if you also look at CBK's borrowing program for the year, they're actually above target, where they've borrowed almost about 90 billion so far, with a borrowing target of 106 for the whole financial year. So they have very little left to go. And I mean, with all these maturities, there's a risk of closing in a net repayment position. So I think most investors are looking at all these aspects, and we've actually seen investors begin to take up positions on the short end of the curve. That is anywhere between 1 year to about 5 years. Most of them are still looking for the double-digit returns we were used to in 2012. So you're still seeing demand coming in at levels of about between 11.50 and 12%. I think there'll be a lot more downward pressure as the maturities begin to pile up. For example, in the month of January, we have about almost 40 billion in maturities. February has the heaviest maturities, which are almost 80 billion. So all these money will have to find a home. And I think investors will stop being so picky in terms of only picking anything with double-digit returns and will begin to accept single-digit returns in the upper 10s. That's anything between 8 to 10%.
If we see, as you say, yields are falling into single-digit territory, are there concerns that foreigners might look, with outside of the borders of Kenya, perhaps look at markets where they are still getting those double-digit returns? Or are the prospects for the Kenyan economy so good right now that foreigners and, I suppose, investors as a whole still lured into the bond market?
I think, of course, we may have some foreigners leaving our bond market, but I think most probably they will stay within our market. Probably look to the equity market, which expects to have quite strong double-digit returns for 2013. And as you mentioned, there's the whole prospects for the Kenyan economy. There's the whole Africa growth story. And I think that's why we're seeing that despite the political risk in the country, we're still seeing a lot of foreign investment here on expectations of post the March elections, where we expect strong growth.
Yep. Just looking at the shorter term right now, we've got some T-bill auctions coming up this week. What are your projections with regards to yield direction on those, and just more broadly in quarter one?
Basically, the 91-day and the 182-day T-bill are almost at the same level. They are at about 8 and 8.1%. I think how it's happening is the central bank is actually trying to control the decline of the rate, so they're not letting it slip. But also, what we're seeing is market. If you look carefully at the average market rate, that is an average of all the bids in the market, you'll see that investors are still quite reluctant to move down below 8% levels. I think this is this behavior is probably because of they were used to double-digit returns. They're trying to match those returns, the maturities and the returns they're getting currently. So there's still a reluctance to bid at 8% levels or even at single-digit levels. I think that's why we've seen such poor subscription levels on the 91 and the 182 day since the beginning of the year. The 364 day is currently at about 11.7%. We expect this will actually weaken. In fact, I think most market analysts feel that the auction in December, this rate was a bit high. Actually, it's in a way you'd say overpriced. So we expect with the next auction in February, the 364 day will probably dip closer to 10% levels and below. And I think for the first quarter, we should expect that despite the heavy maturities, we may see the central bank still trying to maintain the rate at levels between probably 6.5 to about 8%. And also, as you mentioned, we've also seen the shilling has been weakening. This was expected. We've seen investors taking defensive positions on this, on expectations of the political risk and also on flight of capital. So we expect we may see the CBK coming to protect the shilling. And of course, the effect this will have on the rates.
As we have seen in the past, their willingness and ability to do that. But Kenneth, we'll leave it at that. Thanks so much for joining us today. Kenneth Minjire, Fixed Income and Money Markets Analyst at Stanlib, Kenya.